Welcome, Rohan. Retired into the stock market session 10 plus 1. May 4th, 2025. How are you?
I'm good. Eric, how are you?
Very good, thank you. Today we're going to talk about spreads. You're getting level 2, either through Hood or Schwab soon. And that's necessary, by the way. Also, level 3 is necessary, but level 3 is a little more advanced. It's not a little more, you can do a little more risky trades by using less requirement or less maintenance and going into margin more in that sense, getting a better return but having more risk. So level 3 is still important, but level 2 is really important, I think, because the spreads have a way of giving you leverage. Write down leverage. And that's one thing I want to talk about today. Also, leverage spreads is that when you buy an option, let's say, give me a stock.
Into Hood
Let's do
or
Hood. What's Hood price right now?
$49, I think, somewhere. Let me check 1 second. Yeah, it's 48.59.
Okay, 48.59 Hood. 48.59. Now, we're gonna look at an option for Hood. Okay. Let's go. Let's go next month, June. Okay.
Okay.
Let's say June 20th.
Okay.
47 days. And normally we sell the call. Have 100 shares, we sell the call. If it's 48, my mom gonna sell the let's say the 50. Well, there's either 50 or 55. The 50 is paying a 410, which is a great return. Let's say the 50. So it's paying 410 by 420. Let's just say 410, right? But now we're gonna buy the 50 call. So 420, we bet to pay 420, $420, okay, for the 50 call. That basically lets us control 100 shares. For options, I say options are, throw away the definition in the book. Options are how you control the stock with less money but more risk reward.
Okay.
And we're gonna spend $420 and buy one contract of Hood at the 50 strike for next month. 420. And that gives us leverage because we'd have to spend $4,800 to buy 100 shares. But now we're spending $420 to control 100 shares. You can look at it that way. So like 1/10, less than 1/10. And that gives us leverage. And if we look, if I click on, this is the Schwab app, right? You remember your Thinkorswim? You have that?
Yes.
So I click on Hood. Look here, it says in the corner, Delta 57.
Right.
So I'm getting $57 every time the stock moves up 1 point or down 1 point. So I'm gonna put here Delta 57. Now that's important because with $400, I'm basically getting 57 shares of Hood. Now we said it would control 100 shares, but really, it's not dollar for dollar. It's less. So it's in this case it's Delta 57. So in this case, what you do, you go 57 times 48.59.
So what we are doing is we are selling a put, we are selling a call for $50, right? Or is that we are buying the call for the $50?
Well, in this case, we're buying the call in this example.
Okay.
Just want to show you the perspective, okay?
Mm-hmm.
So, since we have Delta 57, if you press on the backboard on the option chain, it'll tell you the Delta, correct?
That's right. Yeah, I have the delta with me.
And
Yep.
so what I'm showing you is that if you multiply 57 times 48.59, this is what it would cost you to buy 57 shares of HOOD.
Okay.
$2,800.
Right.
So not really 4,800, but this is just an example. But we're getting the same return for $420. This is leverage, okay? So if we're gonna leverage basically 57 delta, we can either buy 57 shares of HOOD for 2,800, or we can buy one contract for 420 and have the same leverage, have the same return. So in a sense, if it's 2,800 to 400, so we either buy an call option for 420, and we'll get the same value as $2,800 in shares. Okay, so 2,800 divided by 420, 6.6 leverage. Repeating, do you see that? So we're leveraging
Mm-hmm.
our money 6.6 times. Okay, that's the value of this, of showing you this. So when you have a stock that swings up, which happens all the time, Tesla, Palantir, if you have the shares, you'll get $1 per dollar share. If it goes up a dollar, we get $1 per share. 100 shares goes up a dollar, we get $100. Correct?
Right.
Goes up 10 points, we get $1,000 at 100 shares. Correct?
Right.
Which has happened. Tesla's gone up 25 points. That's $2,500 for 100 shares. Correct?
Yeah.
But now we're going to buy the call option, and we can leverage around 6 or 7 times leverage. So now we're getting, instead of getting $100 a point, we're getting $600 a point. Does that make sense? When we
Yep.
have the
Yep.
call option. So we buy, instead of selling the call option, which is our foundation, is selling calls. We know that.
Right. Yeah.
Now we're going to consider buying the call and taking all the risk. Like this is, if the stock doesn't go up and it goes down, for example, we have a call, your whole position is going to get wiped out. You're going to have zero. Big fat goose egg. Okay.
Right. Yep.
So that's the risk. But we can get 6 or 7 times leverage if we buy the call. And you know how when we sell the call, we get 5% a month. You said 3%, 5% a
Right.
month, 10% a month.
Yeah.
On IonQ, I've been getting 10% for my cover calls. On Rigetti, I've been getting 10% a month for my cover calls. But now we can get 600, 700 return if the stock goes up in our favor.
Right.
So when we have that move for Tesla, for Palantir, for NVIDIA, IonQ, we have the choice to buy the call and take advantage of leverage and having a great return on the option. What I like to do, write this down. When you buy a call, go out at least 2 to 3 months plus. That gives us more time. Okay. When we
Right.
sell a call, I like to be closer because I like to expire worthless. We're taking the time advantage.
Right.
But when we buy a call, we want more time. I don't want you to buy a call for next week, for example. You say you're doing weekly
I'm just doing
puts.
put. Yeah.
Don't buy a call for next week because that's not our
Right.
time.
Yep.
Ideally, you want to buy the call. You want to have 2 or 3 months ahead of you, and you want, like, for example, technically you wouldn't really want to buy June. It's May, June, July. We want to go like to August. Okay, so let's just do that.
Mm-hmm.
Let's just show you August, and we're gonna do HOOD. So let's say we ideally you want to buy at the money or in the money. So let's just do at the money, 48. So and if you go August 15th, it's 103 days. That's the proper time. Let's just do it right. At the money, 48. So 48 costs us 765 by 780. So expensive. $780. Okay. 780. But well, we have 103 days. See?
Right.
HOOD can swing up, right? And I press down on this bar, 48. Delta 59.8. Let's just say 60. Delta 60. Right down. So now we're leveraging 60 shares of HOOD and we're only spending $780. And we know 60 shares at 48.59, 60 times 48.59 equals $2,915. So $2,915, and then we're only spending 780 divided by 780. We still leverage 3.7 times, almost 4 times leverage. Still good leverage. Okay.
How did you calculate that again? If you can, if you don't mind, 780 divided by the delta,
So
is
we're
it?
taking the money that because we have money, right?
Yeah.
We have an investment. We're taking the investment value and we're comparing it either to the shares or to the option. That's what we're doing. So what we do, we take the delta, in this case, 60, okay, for
Right.
the HOOD 48 strike for August, which is 103 days out. Got 103 days to trade it. And since it says delta 60, we're figuring out how much it would cost us to get 60 delta in shares, which is 60 shares. 60 shares times 48.59 is $2,900. That's what it'll cost us to get delta 60. So the option, though, costs us only $780. So we take the total value, which would cost us in the shares, 2,900, divided by 780, and I get 3.7. 2,900 divided by 7. So we're taking the amount we would have to pay for the shares, 2,900, 2,915, divide that by what we're spending on the option, 780, and we're getting the leverage at 3.7.
Got it.
Sometimes we can
Okay.
get three leverage, 10 leverage, 5 leverage, 15 leverage. Now
Right.
if we get an option out of the money, let's say we want to get more leverage, right? Let's say we want to get 10 times leverage, right? So if we're spending $2,900 on the shares, and we're spending 780 on the call option, 10 times leverage would be spending $290. Maybe we'll see. So let me look at the option that costs 290. Okay, and so we're spending 1/10, right? HOOD August. Which one is 290? Goes all the way to 65. 65 strike is 248 by 266. So
Right.
266. Okay, and I click this.
Right.
65 strike leverage. It says the delta only 27, so it's less delta, but it only costs $266. So let me see the true leverage on that. Okay, so 27.96. So 28 delta really around it up to 28,
Right.
and then that would be 48.59. 48.59 divided by 48 times 28, $1,360. And then we're spending 266. So well, this only gives us 5 delta. So it just has to do with going higher and higher. So this is 5 delta because the delta's, I'm sorry, 5 leverage because the delta is lower. Okay,
Right.
but the higher you go on the call option, the more leverage you're gonna get. Okay, but the more risk, because if we fast forward from today to the expiration for in August, and HOOD has not moved, that option will expire what?
Yeah. Worthless.
Worthless.
Yeah.
Right. So the whole position is gone. But if HOOD were to swing up this week or next week, we have 5 times leverage. This $266 option times 5 is gonna be $1,360,
Hmm.
and that's why. So consider at the right time to buy the calls, but be very careful because ideally, you know, most options expire worthless. That's a fact, and that's why when you sell options, you're at advantage, you're at a distinct advantage,
Right.
and the stock will have to move in your favor in these cases to make a profit. Whereas if we are selling the call, stock doesn't have to move in our favor; it just has to go sideways, which is steady same price, and expire worthless, or it can even go up The only way we're going to lose when we sell the call is if it goes down. Then we start losing share growth. When we buy the call, it has to go up. It can't even go across, because if it goes across, it's going to basically decay and break down. And by the expiration, if the stock has not moved in a meaningful way in our direction, that option we invested with the 5 leverage or 3 leverage or 10 leverage is going to be gone, 100%. So that's how we buy a call, and that's how you compare the leverage you get. And if you have 3 leverage, 5 leverage, 10 leverage, you know, though you can get a great return. In this case, you can go from 266 to 1300. The whole thing is at risk if the stock moves against you.
Right.
And if I had $1 for every time someone told me they lost all the money in call options, I have a lot of money. Because with call options, they are very volatile, and the whole thing can go to zero.
Yeah.
And one fallacy I want to hear, like we're talking about financial intelligence. We're talking about specialized knowledge about stocks and trading and options. And one very huge fallacy they teach you, I heard it so many times: options are less risky than stocks, because options you can only lose the money you put in. This doesn't make sense. Options you can lose the whole thing, so they're more risky than stocks. If you have HOOD stock at 48 points, and HOOD goes down 10% or 20%, you lose 10%, 20% of your shares. You still have
Yeah.
something left. If you buy the call and the stock goes down 10 to 20% when you have the call, you lose the whole thing. So
Yep.
you lose 100% on one, and only maybe 10 to 20% on another one. Obviously, the 100% is more risky, but they're saying, well, you only put a small amount, so you only lose what you put in. When you have the stock, you can lose the whole thing, but it's still safer for the stock. And I don't know why they teach that. I think it's one of those things that's just backwards thinking. So consider we have a hot stock. Let's say Palantir. We know Palantir is hot. We know
Yeah.
Tesla at some point will be hot. Like even if you go back when we first started, Tesla's doing this.
Yeah.
And Palantir is in the way. Oh, by the way, Palantir has a very interesting chart. It looks like it's going to break the old high and go into a new high. Let me show you the Palantir chart.
The earnings are coming out tomorrow, right? So
May 5th, I thought.
yeah,
Oh
that's
yeah,
tomorrow.
yeah. That's if I look at I like to do the 6-month chart. 6-month chart is probably the most important chart.
Yeah.
It's right about at the 125. If it can break that, it can go to 130, 140.
Right.
However, it's really vertical, so it can always come back down. So be careful. But this is a stock where I'm going to buy a call option for 3 months out, get leverage, 4 or 5 times leverage, and you can really make a nice return, and you have time to trade it. So, once you get in a profitable position, let's do that now. Okay, Palantir. All right,
Mm-hmm.
go to August. 125. Let's just buy the at the money at 125. Ooh, 20 by 2070. So $2,000. 125 call. But look at this. I press it and it gives me a leverage of 50, a delta of 58. So for every point that Palantir goes up, if I buy the August, write down, August 125 strike call, which is 103 days, it's $20, which is $2,000. And you're going to get delta 58. So what we do, let's do the same math. 125 per share times, actually 124 and change, but around 125 times 58. It would cost us $7,200. It would cost us this much to buy 58 shares to get 58 delta of
That's right.
Palantir.
Yeah.
But then we're going to only spend 2,000 for that call option. So divide by 2,000. So the leverage is 3.6, which is a nice leverage. Okay. So 3.6. So here's the value. If Palantir were to go up from 125 to 130, 135, which is easily done with Palantir, 10 points, my experience, then our $2,000 call option will be times 3.6 times $2,000. We'll have $7,250. So we're going to go from a $2,000 option to $7,250 if Palantir moves up 10 points. Does that make sense?
Right,
Did I do it
right.
right? You can always check my math, And that's with 3.6 times leverage. Will it do that? Maybe, you know. But if it does that and you have the call, what I would do, what do you do? Close, take a profit, walk away. Sometimes people, like I talk about working with Mr. Morgan, you don't have the luxury to lose money. You have to make a profit. So while some people are trying to get, double their money, triple their money,
Yeah,
other people have a lower threshold, a lower goal. So like if you buy a call option on Palantir, you buy the 20 strike for August, for 125 strike for $20, and you want to get a 10-point move in the stock, and you want to make $7,200. But I buy a call option for August for 125 strike, and I want to get a 5-point move. I want to sell it when Palantir gets 130, but you want to sell it when Palantir gets 135. You want to get the better return, but I have the lower threshold. Who's going to reach their goal first? Me or you? If you want to sell the stock at 135, but I want to sell it at 125. I'm sorry, at 130. Who's going to reach their goal
yeah,
first?
the 130 one, right, first.
Right, so I'm going to take my profit sooner. It's easier. I'm going to walk away. Your profit, you have to wait longer,
Yep,
and it may not even get that high. It may just come back down.
right.
So you take more of a risk. So consider that when you have a call option, or any trade for that matter, the more you want to get return, the more greedy you're going to be, and the more chance you have of failure, because the stock can only move so high before it comes back down. So when you look at buying a call option, plan out that you want to get a certain return. Let's just say 100% return. Okay. Okay. So this 2,000 call option for HOOD for Palantir, and then this $780 call option for HOOD. You want to double it. So you want to go to 4,000 for the Palantir, and let's say 1,500 for the HOOD, and that's a nice return, 100%. But somebody else may say, well, I'm just going to get a 70% return, 80% return. So their goal is going to be even easier than yours. And we know there's a lot of selling at some point in shares, and that's going to bring the price back down. So you're just taking more. The more money you want to get, the more risk you take.
Right.
And if you see a hot stock like Palantir that can go up, you want to buy a
Yeah,
3-month call option, and then see if you can. Now you're trading. Now you're taking a risk, because a real risk, because for whatever reason, stock would have come back down and not come back up in 100 days, then you're going to lose that whole position.
yeah, yeah.
So I would say when you buy calls, don't use more than 5 or 10% of your whole account, 5 to 10%. Because what? Because your whole account is what? Balanced. You have what? Dividends. Let's say 30% dividends. Let's say 10% to risky calls. So that's 40%. And then
Right.
let's say 60% to either share growth or cover calls. Does that make sense? Let's write that down. 10% risky. Let's just write down risky calls. 30% dividends. And give me some dividend stocks you like.
So I've got a couple of them, and I'm trying to grow those to 30%. So I have Pepsi, Starbucks,
Pepsi, SPUX, PEP. Any
EP,
more?
PUF, LYB,
LYB,
and UPS.
UPS.
Yes,
What's the yield on UPS?
6.7%.
Wow, that's good.
And it is
Okay.
at an all-time low right now. So I thought, okay, I'll just I bought some when it went down to 94, and right now it's at 96.
All-time lows are good and bad.
I mean,
It's a bad because they're having problems. They're selling off, but it's good because the return on the dividend's higher.
yeah.
And the idea is that you have enough volume, have enough investors, they're going to buy at the price lower, and they'll take the price back up.
Mm. I mean, it's not all-time low, but it is at a low which is comparable to many, many.
52 week low.
Yeah, yeah,
Yeah,
52 week.
okay. And then 60% towards either CCs with cover calls or share growth. And share growth, I just mean holding the shares, buy Amazon, buy Microsoft, Google, Palantir, and just hold it for the long term. That's share growth. And then cover calls is obviously writing monthly, weekly, or elite cover calls. So
Got it.
60%, 30%, 10%. It's balanced. It's a balanced account. And you don't want to put ever more than 5 or 10% towards calls because, like you said, you can lose the whole thing. You can't afford to lose a lot of money.
Yeah,
You don't have that luxury. Like the regular person could be stupid in his account. You can make the most. You can buy it, put everything to a call option.
yeah.
And one day you make double, triple your money. The next day you hold it, start over. You know.
So my question, Eric, over there is the shared growth. So now we have like Apple is there, Amazon, I mean Google. Those are shared growth stocks.
The
But
idea behind the share growth is that you don't really have to trade them that much. You might get a dividend, you might get a cover call, but the idea is that you're just kind of keeping them for the long term. You don't really have to.
right,
It's whole. You're playing the long term play for the shares to go up.
right. But you can still do covered calls on those.
Yes, but technically, if you're doing cover calls, technically then it's more of a cover call. It's a little more risky because now you're capping your upside,
Yeah,
and you're making let's say a monthly return or yearly. But it's technically not a share growth play. A share growth play technically is just holding it and not doing trading. I like to do my share growth plays in my retirement account, my IRA or Roth or IRA.
right, right.
However, I have some Chipotle now,
Mm-hmm.
and I'm not doing a cover call because I think it'll go up a lot higher than the cover call. It's not paying enough in the cover call. If it goes up 3, 4, 5, 10 points, then I get all that share growth. If we
Yeah,
look at the 1 year, 3 year, 5 year, we should be doing well. We should be come back up. So that would be my Chipotle CMG stock will be an example of share growth right now.
right. Okay.
No cover call, no dividend,
Mm-hmm.
no trading really. Don't need to. Questions on that?
No, no,
So we
that's
got
good.
60% for share growth or cover calls. We got 30% for dividends, and we got 10% for trading or call
Right.
options. You can and the 10% trading. You can also use puts. Now puts the same way. I think stock's going down. Like if the stock went so high, or for whatever reason, I think it's gonna come down. Then you buy a put,
Yeah,
and then when the stock goes down, the put goes up.
yeah.
Makes sense.
Yep. Yep.
You learn how you actually make money shorting shares. When the
Right.
stock goes down, the put is behind those shares. When you buy a put, you're leveraging somebody's short shares, somebody's
Right.
short position.
So how does the spread fit into this?
Okay, so that was just one thing you can do when you're
Mm-hmm.
waiting for your other trades to go through. Buy a call, buy a put.
Right.
Play the market. They say risk capital only. Here, write it down. Risk capital only. Because it's not. You don't put your rent money. You don't put your child's college fund. You put just
Right.
the money you can lose because you could probably lose it one day. The spreads is different because it's the same idea actually. Because the spreads also you're spending money and you're not bringing much money back. You are kind of bringing money back when you sell the higher spread, but the spread is like this. Okay, you're buying that call we just talked about. So that's why I talked about that because you're buying that 50 call for Hood. You're buying that 125 call for Palantir. But what you're gonna do is sell a higher call. Okay. So let's just do the Hood first, and we'll do the Palantir. We bought a August 48 call for hood, right? We spent
Right.
780, correct? 103 days, $780. Now there's a couple different ways to think about the spread, okay? And the value of the spread is that there's two advantages to the spread. One is you're technically getting money back, so you can't have a total loss on the spread. Similar to a cover call, when you have the shares, right, the cover call, you can't have a total loss because you're getting money back on the cover call, correct?
Yeah.
So when you buy the hood call for 48, Palantir call strike 125, now you're going to sell the higher call and you're getting money back. So you can't have a total loss. So let's just do a 10-point spread for the hood. So we're going to sell the 58. Okay. If it has the 58, if it has that, we should have that. Let me see. Let's find out.
Also sell the call. So you buy the call and then you also sell the call at 58.
Yeah, you know how I say that when you have the shares of a stock, those shares have value.
Right.
That's your business to sell the higher call every month.
Yeah.
Now we're going to use the call option. They allow you to sell the higher call on the lower call. So we're going
Okay.
to do that right now. So let's look ahead first. August. Do this with me. 103 days out, and let's do a 10-point spread. So we're going to buy the 48 for 780. We sell it. Well, you have to sell the 60 or the 55. Which one you want to sell? The 55 or the 60? It's up to you.
55. Let's do 55.
And so we sell the 55. We get back. It says 490 by 510. So we're gonna get back. Let's just say 490. That's the bid. 780 minus 490. So the total, because we're getting money back, okay, the total cost will only actually be 780 minus 490. Only actually be 290. Okay.
Okay.
And if we sell the 55 and we buy the 48, that's gonna be a 7-point spread. So a couple ways to look at it. First way, you're investing $780 and you're getting back $490 back on your trade. That's one way to look at it. So you have instant return, huge return, okay? But the downside, you can still lose because if we fast forward to the expiration and hood is below 48, this 780 call that you spend $780 is going to be worthless.
Right.
However, we still got the 490 back.
Yeah.
And your cost technically, because we have the 490 back, your cost is only 290.
Right.
So here's a question for you. Your cost technically is 290. Now we lowered your cost, or you get money back, whatever you want to look at it, same difference, okay? If hood is 48 today and you have a 48 strike, it's like a wash. There's no intrinsic value. But if it goes to 49 and you have a 48 strike, you have a $1 credit, right? $1 in the money.
Yeah.
Real value, intrinsic value. So if you're spending 290, okay, on this spread, buy the 48, sell the 55. What's your break even on the hood price if you have a 48 by 55? What's your break even, knowing that 48 call is going to have to be in the money to get you your 290 back? So what's your break even? What's your break even on the hood stock price at the expiration if you have the 48 by 55?
45, right? I mean, if I consider 290 as 300, so it will be 45, right?
You're not. You're thinking selling the option. We're buying now. We have a debit.
Oh, got it. So it will be 48 plus $3, or
Yes,
290. So it
yes,
will be
yes.
40. Okay. So basically
Yeah, you're
$51.
thinking of selling the car.
Yeah. Yeah.
You're spending 290. Okay.
Yeah. Yeah.
So now the 40 has to be in the money by 290 for you just to break even. Okay.
Yep. Yeah.
So that's the risk. So 48 plus 290, 49, 50,
$dollars.
50, 90. Fair?
That's right. Yeah.
At 50.90, you're gonna have 290 intrinsic value, and it's gonna break even because you spent 290. So you bought the 48 for 780, got back 490, spent 290, and then 48, which is your baseline, plus 290 is 1590 is a break even. Now, the other mechanic of this is the maximum you can make is if the stock goes at 55, you're capped at 55.
Right.
However, if you count from 48 to 55, how many points is that?
48 to 55 is 7 points, right?
Right, so write it down, 7-point spread. We'll do Palantir after. We'll do a bigger spread for Palantir. But, so this can only make you $700 total.
Right, but then I have used I've spent 290, so it's basically
Yes,
700 minus 290, right? So it's like
so it can really spend, it really gonna spend
$410, 410,
4, 410
right?
maximum return. But if it's a 410 maximum return and you have a 290 investment, what you go 290 divided by 410, 70% return.
Oh, okay. Yep, yep.
So if you count that you're investing 780, get back 490, cost 290, and then go to 7 points because 48 to 55 is 7 points and it's capped at 55 because you're selling the 55, so you're short the 55. So your 48 55 cap at 55, which is $700, you'll get coming out of this trade maximum, and then you subtract that by what you invested 290, profit 410, 70% return.
Got it.
Did I do that too fast?
No, I mean, I got it. I got the concept. Yeah, yeah, yeah.
So the value of investing in a spread is it's better than just buying a call,
Right.
because if you're going to spend 290 by itself to buy a call, we'd have to buy the 65. Remember,
Yeah,
it
yeah,
was 266. So would you rather buy a 65 call or have a 48 by 55 and have more chance of it being in the money?
right.
See, so there's a distinct advantage in doing a spread. However, the cap is different because the 65 call, which will cost you 266, almost 290, can go to double, triple, quadruple. Can go to if HOOD went to $70 or $80, that 265 call would triple and quadruple. But when you have the 48 by 55 in this case, the maximum you get is $700. So it's capped. Similar
Right.
to when you're doing a cover call, like you're capping the upside of your shares, but you're getting consistent money.
Right.
So, and this actually is similar to the poor man's cover call, but we're not going to talk about that today. But when you're buying a call and you're selling the higher call, you're getting a higher return, more leverage, more chance of failure, but also more leverage.
Right.
So when you buy a call and sell a call, you're getting a chance to play the stock closer to the strike price, more chance of success, and still a great return.
Yeah.
Let me do. Can we go a rich man's? Now, keep in mind that there's 7 point spread, but you're only spending 290, so you know you can double your money in this.
Right.
You know, so actually, I did the return wrong. If it costs 290, and you can get out $7, it's more than 100% return. I did a return wrong. Let me do it right.
Because I think you divided by 400, whatever,
Yeah. I did it wrong. If it's 410, it's your profit
right, 410
divided
minutes.
by 290. I screwed up. 140% return, double what I said. So, but now I'm going to show you to go into money. This is interesting. This might be very interesting to you, okay? Because I know you're a math guy, you're an intelligent guy. You can do a HOOD in the money or any stock, for that example, and they're going to give you a return as long as the stock price maintains. So here's what I'm going to show you, okay? Now let's go in the money. Remember, rich man's.
Mm-hmm.
This might be very appealing to you, a spread, okay? Let's go. How low do you think HOOD can go if it goes down? You want to look at the chart?
Yeah, we can do 40 or something, or 42, I guess.
Um, let's say it goes to 40, okay?
Right.
So we want to do 35 to 40. Can we do that?
Okay.
I'm gonna show you 35 to 40. It's pretty safe, right? As long as
Uh-huh.
you're above 40, you're maximum, right?
Yeah.
So
You're still doing August 15th, correct?
yes, still August, yes.
Yeah.
Okay, so the 35 call is 1675. I'm gonna sell
Right.
the 40 call for 12.15. Here I have cost $4. It's giving me the midpoint, which is a little bit better, but same difference. So plus 35 for 1675 minus 40 for I said 12.55. It's giving me the midpoint. $4 cost. Here's the interesting thing. We know we can only make $5 in this trade, right? So we
Yeah.
get 100. We get maximum $100 profit. But if you look at it this way, $100 divided by $400 investment, 25% return. Okay, a great 25% return is more than a cover call, correct?
Yeah.
But look, all HOOD has to do is stay above 40,
Right.
and we get the maximum return.
Yeah.
So this is how the spread can be very interesting to you because you have a high chance of success, lower return than these leverage calls, but still a great return, 25%. And all it has to do is maintain price above 40. So again, just to review this for the recording.
Yeah.
We're gonna buy a 35 call for 50. Here it has 15 and 67, which is
Yep.
in between. Sell a 40 for 12.55. Get back. It's only cost us $4. But when we get the full 5 points out, as long as HUD stays above 40 for the by expiration, and we do kind of have to wait because to get the full amount because you don't never get the full amount until the expiration. But
Right.
sometimes you can buy a spread and the stock can shoot up, and like you said, like you got like a good return within a couple days when you did your trades.
Yep.
The spread will also go up. It just won't go up 100%. It'll go up maybe you'll spend $400, it'll go like to 420 or 450. You see,
Right. Right.
but you won't get the full 5 points until the actual expiration because there's still time left on the option. But here's a situation where you're leveraging still. You're going into money like a poor man's, which is safer. I'm sorry, rich man's safer. You're buying a 35 call, selling a 40 call, and you have a high chances of success, say it that way, and you have a 25% return. So that's something that you want to add to your arsenal of trades.
Got it.
That's why you need level two. Still, it's risky. Still, it can go down to below 35, and if it does that, then you've lost the $400
Yeah.
because now you have nothing. You know, you spent 15, you got back 12 and change. So you didn't lose everything, but you lost that $400 because it's below 35 in that case. But if you have the shares, then you just lost some share growth percentage wise, and you still have a position. You have a cover call, you got money for the cover call, and the stock goes down, you still have the position. But in the case of a spread or a call option, you get wiped out.
Got it.
So that's a good trade to add to your arsenal. Any questions on that?
No, no, this is a good, yeah.
Should
I
we
mean,
do Palantir?
yep. Yep.
Okay. On Palantir, because it's a bigger stock and can move more, I want to add I want to add a higher spread point.
Yeah.
So let's look at Palantir. We're gonna do so. Let's just go in the money because I want to be safe. Like a rich man. I think it went down to 100. Did it go down to 100 recently? 95.
Yep.
So tell me what it can go down to. Not like maximum, but just like a nice dip.
I would say about 100, between 90 and 100, I would say is a good bet, right?
Can we do 90 by 105? A 15 point.
Yeah.
So let's do August, 103 days. Buy the 90 call because that's going to have value.
90 call, right? You're saying?
Yeah.
Yeah.
Sell the 105. On here, on my app, I have $10, 10.15. $10.15. Cost. It costs 41 and get back 30.
Right.
So if you're spending 10.15, we know that the maximum you can get is 15 points because it's a 50-point spread. So 15 points. So the maximum we can get is 485. $485 back. Okay. Because we're investing 10, 15, and we're getting back $1,500 as long as Palantir stays above 105. Okay.
Right.
Let's do the math on that. 4 point, I'm sorry, 485 divided by your investment of 10, 15. Is this right? 47% return.
Why is it 485? It should be 1500, right? Divide by 1050.
Is that what you're doing?
So you would have got 1500 profit, right? Or yeah, you would have got 1500 profit from 90 to 105. That's 1500 profit.
Yeah, but it's not profit because we're spending 10, 15 to do it, to do the trade,
Oh, okay. So you're doing 1500 minus 1050, right?
which is
That's
485 profit.
oh, okay. 485 profit.
And we divide the 45 by the total investment, and I get 47% return.
Got it.
47.7, 47.78, 48% return. 47.7, 47.8.
Got it. Yeah.
So we're investing total $1,015.
Yeah.
Buying the Palantir August 90 and selling the 105.
Right.
And the maximum we get is 15 points at the expiration, which is 485 profit, and it's 47% return.
Yeah.
So just think for a second. All Palantir has to do is stay above 105, which is 20 points buffer.
Yeah. Yeah.
That's a rich man's trade because you're only getting $400 return, $500 out of a $1,000 investment, which is 47%. Still a great return,
Yeah.
and it has to go way against you to break even and to lose money. You have to go. Let's see. As long as Palantir was 90 plus 5, 95, you break even. 94.85. I'm sorry, I did that wrong. 90 plus 10, 15. So 100 and as long as Palantir is $100.15, you break even. Because you spend
Right.
10 points, and that 90 call will have be 10 points at the expiration.
Yeah.
But as long as we're above 100, we're in profit mode. And Palantir is 120, 124.78. You know it's going to break 125 tomorrow. I'm going to just tell you, tomorrow, going
It's
up.
going up,
Because why?
huh?
Because people are going to play those earnings,
Yeah.
buy the shares, looking for those earnings. Now, a couple of things are going to happen. At some point, if it swings up, it'll come back down. So be aware for that. But also, if they have bad news, that can bring it down. And anyways,
Right.
once the earnings come out, it might shoot up more, it might come down more a lot. So that's the other trick is that all this movement we had can be blasted away if people don't like the earnings. If the earnings aren't great or stellar, they'll probably just come back down to 120, 115. And
Right.
those people who had those calls, those lofty calls up there, get blown out. People lose their share value, share growth that are up there with 124 shares. But this spread is airtight down
Yeah.
to 105, 100 Palantir.
Yeah.
So that's a rich man's leverage right there.
Right.
And that's why you need the spread. That's why you need that level two. You understand now?
I understand. I'm going to try even harder to get that level too.
Excuse me, sir. I need my level two.
Yeah.
Otherwise, we're gonna have a meeting.
Yeah.
Actually, don't threaten them, but you know what I
No,
mean.
no, I understand. No, but this is Yeah, this is very interesting. I did not understand spread at all. So this, I mean, I don't want too much profit, right? So I'm good with like doing rich man's trade in and getting that, even 40-50% profit. That's good enough. I mean, I'm not looking for huge profit gains or anything like that. But
I just thought of Rohan as the mob boss. You know what a mob boss is?
hmm
I just thought of Rohan as the mob boss.
oh,
You know, like when you need to have something done,
yeah, yeah.
to send Louis to take care of the job. You know, sometimes you have to be, uh, aggressive. You know,
Yeah,
but yeah. So as a call option brings you money when it's in the money,
yeah,
the spread the same thing, except the spread is capped at the higher
right.
call. But the values you're getting, since you're getting money back, that gives you a nice advantage.
hmm
Okay, so as long as you don't mind capping yourself, you can go in the money and get a nice return with a high chance of. That's what it is. It's a high chance of success. Write it down. High chance of success. High chance of success, which is in the money spread. In the money spread. 47%, 25%, whatever the percent is, it's probably gonna be pretty meaningful. And it's a higher percent than the shareholders get,
Yeah,
you know.
yeah,
When you came to me, you were just had the shares, right?
yep.
Now you're looking at 47%, 25% yearly return income, paying your bills. Come on, man.
No, I'm
Are,
looking
are
at
you are
that.
you are you grateful?
Oh yeah, absolutely. 100%. I mean, more than 100% if I can.
More than
Because
100%. I like
oh
that. More
yeah,
than 100%.
because the stacking, I mean, the money I get from the covered calls, I use that for maybe purchasing some additional stocks, maybe doing some swing trade. Like I did one for Palantir, where I didn't have too much cash, but whatever covered call money I got, I bought like 20 stocks at of Palantir at $78, and I sold it on Friday at $124. So I made like,
Damn, you're a trader. You're a trader, man. Dang. Now
no, no, there was,
now you know it's probably gonna go higher tomorrow. I'm just gonna throw that
yeah,
out there.
I
But
just, yeah, I just took the profit of 78 to 24. That's like, I mean, 78 to 24. Yeah, that's a good profit for 20 shares and moved on. So,
I'm just gonna say, even if you bought some shares back tomorrow morning at the open, probably by the close, as long as the market is decent
right.
and we don't have any bad news on Palantir, it's gonna go up tomorrow.
Yeah,
They say, buy the rumor, sell the news, right?
yeah,
Which is because once the news comes out, we know it's only so good. We know it can only be so good. But when with this hype, this rumor, people get excited. Maybe it'll go, jump up, to $200.
yeah,
And they buy that hype, that rumor, and then once the news comes out, well, they did okay, so whatever. We're just gonna sell it now because we'll just find another magic, stock, and
right.
then it goes down after the news.
Yeah,
So be prepared for that to happen. Now, sometimes if the news is great and things are really great, it'll just go up even higher on Tuesday, Wednesday.
yeah,
That could happen too. And at that point, that's the time when the call option is going to pay off. And we can talk about that maybe in the next session or two. Is that you can have a call option. My record is 29 fold call option. I bought a call option for 50 cents. It went to $14. That's my record. However, I don't want you to do that because that's a risky trade. But you want to have that in your arsenal, in your tool shed.
hmm
A proper gardener, uh, toolsmith goes in his tool shed. He has hammers, the saw. He has the screwdriver, the bits. He has
yeah,
electric, you know, um, machine. He has everything. So
yep,
you want to have we know how to do 100 shares, write a cover call. We know how to buy a call, buy a put. We know
Right.
how to do a leap.
Right.
Right, 3 years, that's stacking. Now we're looking at buying a call, and then the difference between buying a call and buying a spread, which is cost
Right.
money, and then getting the return on those, the difference in the return.
Yeah. Yeah.
Yeah, so you want to have all these tools in your shed, and you want to use the appropriate trade. Try to always be safe. Ideally, be safe. But we really doing you're really managing your risk. We're right down managing your risk,
Yeah.
managing your risk because it's all risk. There's
Yep.
no risk, there'd be no reward, there'd be no reason to do trades.
Yep. Yep.
When an entrepreneur gets some money together and buys a business or buys a thing you want to buy and sell it for more, whether it's a service or a product, they're taking a big risk because if they don't sell that product at a profit, they're going to lose money, and then their business is going to be. Same thing with the stock. We're looking at a good stock. We have our stock selection. We want to go 10-year chart. We want to have high volume. We want to have a
Right.
dividend. Ideally, stock splits. We want to have all these things we like. Has pays nice on a cover call. You can buy that product easily. You have an all-time high recently. All-time high.
Mhm.
All these technical tools, indicators, and then you do the position, and you want to do the appropriate position. We're doing the monthly cover call. We're doing the in the money rich man's spread, or we're doing a leap. Getting money back, doing the stacking. So all different kind of choices. You have all these things for you, just to right at the appropriate time. And if the stock goes down and the market goes down, hopefully you have a put hedge. Do you have the put hedge?
No, I've not done it yet. I mean, I sell puts, but I've never done a put hedge.
We'll talk about that next session.
Okay.
But you also have the dividend,
Yes.
regardless. So you have a 5% yield, 6% yield on UPS, 100K, $6,700 per year is something. You know, you people. I say supplement their Social Security with dividends.
Right.
So let's say I have $1 million in your IRA account at 5% dividend yield is $50,000 a year, and that way you can supplement your Social Security. And $1 million, $2 million at 5% is $100,000 a year,
Yeah.
and you don't have to trade. You don't have to worry about the market swings. Just hold the shares, get the dividend.
Yep.
And I think that's somebody, old people do that. They don't bother with all this risk. All these risky trades. They just hold the shares, get the dividend. If they
Yeah.
have extra money, they can buy more when it goes down. Like Pepsi's down, buy more when it's down.
Yep.
Questions? We covered
No, this was.
spreads.
Yep.
There's also a put spread, but we'll talk about that next time. We don't have to talk about that, but you get the idea of a call spread. We're getting back money, and we're allowing us to have the right amount of leverage with a safer trade. And when you go on the money, the return is lower, but still a great return and a higher chance of success in a rich man's in the money spread. Kind of amazing, I think.
Right.
And if the stock were to go down, then you wish you would a lower spread, you know.
Yeah. Yeah.
And the stock were to swing up like crazy, you wish you bought a call and didn't write the spread.
No,
Makes
don't be too
sense?
greedy. I don't want to be too. I mean, I always keep saying, don't be too greedy.
Yeah. Greed,
Yeah. Just
call it a
take it.
win.
Yes. Yes,
Call
sir.
it a win for today.
Yep. Yep.
Thank you, sir. I'll send you this when it's ready, and we'll do it session 11 next week.
Yeah.
And I want you to practice your presentation.
Yeah. I've started preparing at least the outline of what I want to cover. So I've started jotting down notes and all that stuff and started prepping the slides.
Yeah, you don't have to overdo it. You're just going to basically give a nice explanation on what we're doing and how to retire in the stock market. Give us some
Right.
numbers. So you want to make $10,000. Show us a trade to make 10,000
Yeah.
or 5,000,
Right.
and then talk about dividends, cover calls, maybe some spreads. But you want to keep it simple because you want to be able to appeal to the average person.
Yeah.
I think it was Einstein who said, no matter what kind of specialized knowledge you get, if you can't explain it to the average person, it's worthless.
Yeah.
So keep it simple.
Got it.
Thank you, sir. Um, did I record that?